Lobo, same question over to you. Where are you looking to allocate capital right now? Are you? And if so, what are you looking for?
Well, I'm long already. I like the development space in particular. A claim to fame, if I have one in the mining space, is my work on the pre-production sweet spot. And we've had a couple more cases in the last few months of successful PPSS plays. And that's really important because most PPSS plays in the database are gold, silver, and there were a few uraniums in there. So we've had some confirmation of this thesis, of this ramp up through the pre-production, the end of the Lassonde curve. So that's good to see. It really does work for uranium as well, and there's more of these out there. So I'm looking for a credible, robust feasibility study at a price that's below the accepted incentive level. So let's say you have a study that's 2 or 3 years old and it says this works at $70. Now that looks great at 106, but the costs have moved since then. I'm much more excited about a robust feasibility study that worked at 35, 50, something like that, and there's a few of them out there. You know, even if costs have gone up, I'm less worried about that in a robust study. And we have seen PPSS plays in this space deliver in very recent memory. So I really like this a lot. There's not a lot of them, but there are some. They're happening now. If we get a correction and we get a lot of this has been priced in. The obvious winners in this space, we talk about, the stocks aren't as well as they were in 2001. By the way, in 2001, I rained on the parade as well. And people were like, he's got no conviction. He's talking about taking profits. We're just getting started. Why is he talking about taking profits? Well, because market's correct. And there's people that still, whine about, the stocks aren't as where they were in 2001. Yeah, but if you took profits in 2001, you're okay. So I'm looking for, hopefully, as a buyer, a correction to back up the truck on the pre-production stories. Exploration, I like a resource. I want high margins if I'm going to go there. I'm not confident that Greenfields is going to make it in this cycle. There's a lot of uranium out there. Our good friend with the 1 billion pounds of uranium that's just waiting to flood the market, right? Yeah, Greenfields is a bit of a stretch. So I like the pre-production sweet spot. I'm okay with producers that are ramping up or going places. But if you're a producer, I want to see profit. Okay, maybe your first startup quarter, you've got extra costs and things. But once you're up and running, you're a producer, you're supposed to make money. If you're not delivering to the bottom line, that's a cardinal sin in my book.
Quick break here. This episode is brought to you by West Red Lake Gold Mines. Now, if you know nothing about West Red Lake Gold Mines, let me tell you one thing. This company was founded on the back of a transaction where they purchased the Madsen mine in northwestern Ontario in an area called the Red Lake Gold District, which to date has produced around 30 million ounces of gold from some of the richest gold deposits in the world. Now, what they paid for this mine versus what they got has led legendary mining entrepreneur Frank Giustra to call this transaction the deal of the decade. And Bob Moriarty, founder of 321 Gold, was recently on my show calling West Red Lake Gold Mines one of the 2 most undervalued gold companies in Canada. If you're curious why these individuals are so excited about West Red Lake Gold Mines, hit the link below to learn more. Now back to the episode. But where should investors look for value right now? And Daniel, I'll start with you.
I think from the developer's point of view, you've got to look at the companies that can actually deliver on their projects. This is an interesting, while most aspects of our industry are pretty the same as any other commodity, uranium is it brings with it a whole bunch of other different risks that are associated with radiation. But also look at projects from a technical risk point of view. And I pointed our own project in Zambia. It is a straightforward open pit project that goes straight into the same process plant that you would have in an ISR mine. It's that simple. You compare that to the deep level uranium development projects you've got here in Canada, which if they go wrong, even by the smallest amount, their impact on the market is massive. So projects like ours, which are really easy from a capital allocation point of view to put together, we're working in Africa, the permitting is relatively straightforward. Focus on those that can get built and have a lot less risk of not getting delivered versus the highly technical projects that, while they look expensive and highly valued already, come with a lot of risk when they go wrong.
Fabi, same question for you. What end of the risk spectrum are you looking at right now? And what style of company are you allocating capital?
So I like anything with a resource. There were many companies, and there's still many companies out there with resources that were not economic at 20, 40, 60. But at 100, fingers crossed if this is sustainable, all of a sudden they're starting to look a lot more than zero. And I think that people haven't caught on to that yet. Later stage development is also interesting again, finally with this re-rating of the price. I wasn't too keen on the developers for a while there because, I thought that the market had caught on. They looked at the financials. A lot of some production was expected. And, there wasn't much upside to the numbers that we were seeing these companies put out. So everything would have to work out really well for you to make some money maybe when the price went up. Now the price is up, which is significant. And so you have to go back to the feasibility studies that these companies have put out. And, what looked like 75 US dollars per pound, like maybe someday we'll reach there. It's like, okay, you can maybe contract at this level nowadays. So.
Dan,
just on that, if you put in, I get often asked what our projects are worth, priced in now. At $90, I've got $1 billion of MPV on my two projects. So even if you take the one out that's in Niger for nothing, you're still getting Zambia really cheap from a value. And as I said, it's a really simple project, and you get the other project for free.
Okay, I love that. Thank you.